How to trade for beginners. That is the topic for this video, which means I'm gonna focus on the introduction of Forex. Forex is a skill that takes time to learn. Skilled traders can make money in this field. Like any other occupation or career, success doesn't just happen overnight. There's no substitute for hard work, deliberate practice, and diligence. Everything worth it, you won't achieve it easily, you have to put in the work. PCB Trading, it is a trading group, genesis of digital world. Content page, introduction. What is Forex? It is important to understand the definition of Forex. Understanding currency pairs, understanding spread, and the pip. Most traded currency pairs. This is the information which we are going to cover in this video. The next video, it will be intermediate level, which will cover fundamental analysis, technical analysis, and other important information which traders must have. The third video, which will cover the PCB trading strategy and risk management. I've collected all this information to share it to people who really want to trade or who really interested to know how to trade Forex. There's no need to panic, guys. I'm gonna cover every information. Yesterday I was trading CPI. I deposited 1,000 and I made a profit of 1,583. I ended up withdrawing 2,123. In my trading balance is 459. It was a good trade using our PCB trading strategy. Alright guys, what is Forex trading? Forex, it is short for foreign exchange. The transaction of changing one currency into another currency. This process can be performed for a variety of reasons, including commercial, tourism, and to enable international trade. Forex is traded on Forex markets, which is open to buy and sell currencies 24 hours a day, 5 days a week, which is Monday to Friday, and is used by banks, businesses, investment firms, hedge funds, and retail traders. What you must understand, guys, us as retail traders, we trade with the aim of making a profit. Banks, they trade to stabilize the price of a currency. Us as retail traders, we trade with the aim of making a profit. That's what you must understand. Even hedge funds, they are trading with the aim of making a profit. Example, let's say you want to visit in the United States of America for 1 month. You are from South Africa. To visit into United States of America, you need to exchange your rands into dollars. Current exchange rate, USD and ZAR, between USD and ZAR is 14 rand, meaning $1 equals 14 rand. Let's say you have 10k, 10,000 rand. You want to exchange it into dollars for vacation, which means you have to divide 10,000 rands with 14. Then it will equal to $714. As you are in the United States of America, employment increases, GDP increases, and exchange rates increase into 19 because of GDP increase and employment increase, which means the dollar was doing good. It was increasing in value because of GDP and employment change. Exchange rates change into 19 due to good economy of USD. You decide not to use your $714 in your vacation. Then you come back to SA. Now you have to exchange your $714 back into rands, which means you will save 714 times 19 because the exchange rate, it has changed into 19. It was 14, now it is 19. It has changed because of the good economy of the US, because of GDP and employment which has increased. So now you ended up having 13,000 13,566, which means we ended up making a profit because we have 10k, 13,566. You ended up making a profit of 3,566 when you came back here to South Africa. That's how Forex works. Understanding currency pairs. All transaction made on Forex involves the simultaneous buying and selling of two currencies. There is a base currency and a quotes currency. Currency on the left, it is the base currency. Currency on the right, it is the quotes currency. Currency on the left, it is the strongest currency. This currency pair is made up of base currency and the quotes currency, whereby you sell one to purchase another. The price for a pair is how much the quotes currency costs to buy 1 unit of the base currency. You can make a profit by correctly forecasting the price move of currency pair. We have covered this. The currency on the left equals to 1. That's what they are saying here. And if you say buy and price increases, when you say buy, you are meaning euro will gain the value. When you say buy and the price increases in value, which means you're gonna gain a profit. But we're gonna cover that on other videos which I'm going to share. Essential components of currency pair trading. Base currency. The base currency is the first currency that appears in a Forex pair and is always quoted on the left. That's what I was saying to you. This currency is bought or sold in exchange for the quotes currency and is always worth 1. Based on the example above, it will cost a trade 1.918 USD to buy 1 euro. Alternatively, a trader could sell 1 euro for 1.1916 USD. Quotes currency. The second currency of a currency pair is called the quotes currency and is always on the right. In Euro USD, for example, USD is the quotes currency and shows how much of the quotes currency you will exchange for one unit of the base currency. This information is straightforward. The bid price. The bid price is the value at which a trader is prepared to sell a currency. This price is usually on the left of the quotes and often in red. The bid price is given in real time and is constantly updating as it is a live market. You know, the live market is the exchange rates always changes. Ask price. The ask price, it is the value at which a trader accepts to buy a currency pair, or is the lowest price a seller is willing to accept. This is usually the right and in blue. The ask price is given in real time and is constantly changing as it is a live market. Understanding spreads and PIP in Forex. As Forex traders, you will notice that the bid price is always higher than the ask price. The difference between these two prices is the spread. In other words, it is the cost of trading. The narrower the spread, the cheaper it costs. The wider the spread, the more expensive it is. That is straightforward. For example, if USD is trading with an ask price of 1.918 and the bid price of 1.1916, then the spread will be the ask price minus the bid price in exchange, which is 0.002, which is the spread. In other words, to make a profit in foreign exchange trading, you will want the market price to rise above the bid price if you are long. Short, meaning you are selling. Long meaning you are buying. Short meaning you are selling. A pip means a point in percentage, or pip for short is a measure for the change in value of a currency pair in the forex market. What are the most traded currency pairs on the forex market? There are 7 major currency pairs traded in the forex market, all of which includes the US dollar in the pair. You can also trade crosses which do not involve the USD, and the exotic currency pairs which are historically less commonly traded and relatively illiquid. This means they often come with wider spreads, meaning they come expensive than crosses or majors. Major currency pairs are generally thought to drive the forex market. They are most commonly traded and account for over 80% of daily forex trade volume. There are 4 traditional majors: Euro USD, GBP USD, USD JPY, and USD franc, and 3 known as the commodity pairs: Australian dollar, USD CAD, and NZD. These currency pairs typically have high liquidity, which means they tend to have low spreads. They are associated with stable, well-managed economies and are less prone to slippage, where the expected price of a trade differs from the price the trade was executed. Which means if you are trading majors, they are less expensive, which means their price, they don't have some slippage like the exotic pairs. So if you are trading news, I prefer to trade the major currency pairs to avoid slippage in the forex market. The crosses. Cross currency pairs known as crosses do not include the US dollar. Crosses do not include the US dollar. Historically, these pairs were converted first into USD and then into the desired currency, but are now offered the direct exchange. The most commonly traded are derived from minor currency pairs and can be less liquid than major currency pairs. Examples of the most commonly traded crosses include Euro GBP, Euro franc, and Euro JPY. Exotic pair. Exotic pairs are currencies from emerging or developing economies paired with one major currency. Compared to crosses and majors, exotics are traditionally riskier to trade because they are more volatile and less liquid. This is because these countries' economies cannot be more susceptible and intervention and sudden shift in political and financial development, which means these currencies, they are not stable, they are expensive to trade. There are a lot of spikes which comes in these pairs. If you trade these pairs, there are a lot of spikes which occur in the forex markets when there is news. So you have to avoid them if you are trading, because you can make a lot of losses in the forex markets. But we're going to cover that information. Today we are covering the the introduction of forex markets only. Thank you. In this video, we're just covering only the introduction of forex markets. On the next video, we're gonna cover the intermediates, and the third video we're gonna cover the advanced, which includes the strategy. So we're gonna share a lot of information, guys. Always be updated on us. Thank you.